Aggarwal, Academic Counselor, IGNOU. Today we are going to study MMPC 14, Financial Management, Block 3, Financing Decision, Unit 10, Capital Structure. What is the structure of capital? Capital is built of what? You see, capital is the backbone of any business. Without money, we cannot, start business. Small businessman, say a kirana shop, if he wants to open a kirana shop, he will take a shop on rent, then he will buy kirana goods from wholesale market, and then he will start selling to retail customers. For taking the shop on rent, you need the money. For buying the kirana goods, you need the money. Then when you will sell, money will start coming to you. So what the businessman invests in his business, that is his capital. So capital is the backbone of any business. It is the financial foundation upon which a company's operations and growth depend. Every organization requires funds for two main purposes: working capital for day-to-day operations and long-term capital for fixed assets. Now, same example of kirana shop. He will need some fixed assets. Say this is a small shop, so for furnishing, he will need some furniture for the shop, and that is his fixed asset. And the grocery items, the kirana items which he bought, which he is going to sell, so that the money for which required for buying those, that is working capital. So he will be requiring fixed assets. He will be requiring money for buying fixed assets, as well as he will be requiring money for buying other assets. So he needs capital, he needs money for both. So capital is the backbone of any business. Similarly, in case of companies, if it is a private limited company can be started by two persons. If they share 50,000 rupees, 1 lakh rupees capital is required for a private limited company, and if each one contributes 50,000, they have to get the company registered with the registrar of companies. Every state is having a office, registrar of companies, office, ROC, where private limited companies to be registered, and then they can start doing the business. So capital is the backbone of any business. It is the financial foundation upon which a company's operations and growth depend. Now we discussed about private limited company. Public limited company, where they collect money from people, they sell the shares. Suppose Reliance, Reliance comes out with a new project, new company. So they will sell the shares of 10 rupees of that company. They may sell it at premium, or they may not sell it at premium. Now 2 rupees allotment, 2 rupees application, 2 rupees allotment, and then 3 rupees first call, 3 rupees second call, like that. 4 stages. They will collect the money in 4 stages. It depends on them, how they collect the money. And people apply for shares, then they do the allotment. Suppose they have received 1 lakh applications. Now they have come out with 10,000 share, 10 lakh shares, and accordingly they will allot all the shares among the applications received by them. So this money is the capital, share capital for the company. So they will use it as working capital. They will use it for buying fixed assets also. So this is, you see, why they need money. We discuss about that. So capital is the backbone of any business. It is the financial foundation upon which a company's, you see, operations and growth depend. Every organization requires funds for two main purposes: working capital, day-to-day expenses for day-to-day operations, and long-term capital for fixed asset investment and expansion. These funds are raised from multiple sources. They can, you see, collect money by issuing shares. Say we are talking about a company, then they can borrow from the bank, financial institution. Then you see these funds are raised from multiple sources. You see equity capital, debt, you see they can issue debentures. Then retained earnings, whatever are their earlier earnings, they can again deploy them in this, you see, business. Then reserves also. The total mix of all these funds is called the financial structure of the company. Now what do we mean by financial structure? The total mix of all these funds taken together, that is the financial structure of the company. Which funds, you see? These funds are raised from multiple sources such as, you see, equity capital, debt, retained earnings and reserves. So if we combine all these, it is the financial structure of the company. This means company has raised, you see, money by issuing shares, so much amount. Then debt, you see, suppose for example debentures, company has, you see, issued debentures, then fixed interest they have to pay to the debenture holders. Then earlier earnings retained in the business, then reserves. However, within this, you see, broader term, the capital structure specifically refers to the, you see, composition of long-term sources of finance. The capital structure specifically refers to the composition of long-term sources of finance. Suppose you have, you see, borrowed money by issuing debentures. Now debentures will be redeemed after 5 years, after 6 years. So this is one part of, you see, this is one part of capital structure. Then you have raised term loan from a bank, say for buying machineries of 1 crore, say, for example. So repayment period is 7 years or more. That is another part of capital structure. So the capital structure specifically refers to the composition of long-term sources of finance, excluding short-term liabilities. Short-term liabilities are not taken into account. See, long-term liabilities. Capital structure primarily includes equity shares, preference shares, debentures, term loans and retained earnings. Now equity shares, once the new company formed, issues the shares, then that amount will remain with the company only. Shares will be purchased and sold, bought and sold in the share market. But company will enjoy that, you see, capital till it closes down. Then preference shares, the shares, you see, where they give preference for paying dividend, preference shares, that capital also will remain with the company till the company, you see, closes down. Then debentures, you see, say they will say that you give us 1 lakh, we will issue you debentures, 1 lakh rupees, and we will pay you 9% interest, 10% interest. So by this also company borrows the money, and these debentures, it is written on the face of the debenture when it is, you see, due for payment. They are, say, 5 years they have issued, redeemable after 5 years, redeemable after 6 years. Then next is, you see, term loans. Now what is a demand loan and what is a term loan? Demand loan means if the repayment period is below 36 months, that is a demand loan. Term loan, if the repayment period is more than, you see, 3 years, that is term loan. So here we are considering term loans in the capital structure. And last is, you see, retained earnings, earlier earnings again deployed in the business. These funds are relatively, you see, permanent in nature. These funds will remain always with the business and shape the long-term financing decisions of a firm. So these firms, money collected by these, you see, sources, it will remain with the company for long duration. For example, equity shares, that share capital will remain with the company for long duration. Then preference, you see, share, that is also same type of, you see, but they are paid, they are given, you see, preference. When the company pays the dividend, first they have to give to equity preference shareholders, then they will give to equity shareholders. Then debentures, company has borrowed the money by issuing debentures, says redeemable after 6 years, 7 years. Then term loans also, repayment period is say 7 years. Retained earnings we have already discussed. So capital structure primarily includes equity shares, preference shares, debentures, term loans and retained earnings. These funds are, you see, relatively permanent in nature and shape in the long-term financing decisions of a firm. Since short-term funding requirements, you see, fluctuate frequently and are influenced by seasoned or operational leads, they are not considered, you see, part of the capital structure. You see, short-term, you see, requirement, short-term funding. Suppose the business is seasonal, so during season the company will need more money, and out during when the season is not, the company will not require much money. So because of this, this requirement is not part of, you see, capital structure. Since short-term funding requirements fluctuate, you see, frequently and are influenced by seasoned or operational needs, they are, you see, considered part, they are not considered part of the capital structure. Next is, moreover, decisions related to capital structure are policy based and have a long term, you see, impact on the company's solvency, financial flexibility and profitability. For instance, a company's debt equity ratio and dividend policy affect how much it, you see, retains from profits, influencing future, you see, funding capacity. So decisions related to capital structure are policy based and have a long term impact on companies, you see, solvency, financial flexibility and profitability. For instance, a company's debt equity ratio means debt equity ratio is debt divided by equity. You see, borrowed funds divided by own funds, you see. Now most of the firms, the debt equity ratio 2:1, 3:1. It is, you see, considered good for, you see, bank loan. You see, they prefer, if the debt equity ratio is 2:1, they will prefer. And next is dividend policy, how much the dividend, you see, company is going to give, what is the policy of the dividend, you see. Both these things, you see, tells that how much the company retains from profits, influencing future funding, you see, capacity. So decisions related to capital structure are policy based and have a long term impact on the company's solvency, financial flexibility and profitability. For instance, a company's debt equity ratio and dividend policy affect how much it retains from profits, how much it is retaining from profits, influencing, you see, future funding, you see, capacity. A poorly designed capital structure can constrain business growth, weaken investor confidence and increase financial risk, while a well structured one enhances shareholders value and strengthens the company's market position. In essence, capital structure is not just about financing, it is a strategic decision that integrates cost management, control, risk tolerance and future sociability. So it is very important. Capital structure is not just about financing, taking borrowing money. It is a strategic decision that integrates cost management, control, risk tolerance and future scalability. Concept of capital structure. Capital structure represents the proportion of or mix of debt and equity in a company's total capitalization. It is essentially how a company finances its assets and investments through various sources of long term funds. This mix may vary from company to company and industry to industry based on several internal and external factors. For example, a capital intensive company in infrastructure may have a different structure compared to a tech startup with lower fixed capital needs. Capital structure is not static. It requires active planning. From where to collect the money, it requires active planning and periodic revisions. The aim of capital structure planning is to determine the right balance between debt and equity that minimizes the cost of capital and maximizes the firm's value. The planning should be tailored to the specific operational, financial and strategic realities of the firm. Smaller firms often overlook formal capital structure planning and make ad hoc financing decisions. While this may work temporarily, in the long run it can lead to inefficient use of funds, higher financial costs and limited access to external capital. In contrast, larger firms and professionally managed organizations use models, benchmarking and financial analysis to determine optimal capital structure ratios. Capital structure also includes retained earnings, which are reinvested profits rather than distributed as dividends. These internally generated funds are critical, so they reduce the need for external financing and carry no direct costs or dilution of control. In theory, the ideal capital structure is one that results in the lowest weighted average cost of capital and the highest market value of shares. However, in practice, such optimally is difficult to achieve due to mixed imperfections, regulatory constraints and information asymmetry. Still, business can aim for a target capital structure, adjusting their financing decision over time to move closer to that target. An appropriate capital structure aligns with the strategic goals of the company while serving the interests of various stakeholders, particularly equity shareholders, who are the ultimate risk bearers and owners. The following features are essential for a sound capital structure. Number one is profitability. A good capital structure should enhance the company's ability to generate maximum returns for shareholders. This requires the judicious use of financial leverage, employing debt in such a way that the return on investment exceeds the cost of borrowed funds. See, we are paying interest on borrowed funds. So they cost to the company. So if company has invested the money somewhere where this cost is met out, or where the interest is given more than this cost, so it is good for the company. So the next is if managed well, leverage can significantly increase earnings per share. We write it as EPS, earnings per share, and return on equity, ROE, return on equity. However, excessive debt may also lead to interest burden and financial distress, especially when earning fail or earning reduces. Second point is insolvency. Solvency refers to the company's ability to meet its long-term obligations. Excessive debt threatens solvency by creating fixed interest and repayment commitments, increasing the risk of default. A balanced structure ensures that the firm maintains financial stability even during downturns or periods of declining revenues. It's vital that the company retains enough liquidity and cash flow capacity to meet interest and principal repayments without impairing operations. Third point is flexibility. We saw first point profitability, then we saw solvency, then we saw flexibility. They are the features of an appropriate capital structure. A flexible capital structure allows the firms to respond quickly to emerging business opportunities or threats. This includes the ability to raise additional funds without substantial cost or delay, and to restructure financing, that is redeem debt or issue equity as required. Companies operating in dynamic industries or uncertain economic environments should particularly value flexibility. Next is control. Control is especially important for closely held or promoter driven companies. Issuing new equity might dilute ownership and decision making power, potentially shifting control to outside investors. In such cases, preference shares or debt become attractive alternatives, as they do not carry voting rights. However, debt lenders often impose restrictive covenants, which can also limit operational freedom. Thus a trade off is required. Next point is risk balance. A good structure ensures that risk is well distributed among equity and debt holders. While equity absorbs residual risk, debt holders demand fixed returns. Companies must manage their risk exposure by avoiding over dependence on a single funding source. Next point is industry alignment. Each industry has benchmark capital structure norms. For instance, utilities and telecom sectors tend to have higher debt levels due to steady cash flows, while technology companies may rely more on equity, an ideal capital structure should not deviate excessively from industry averages unless there is a clear strategic reason. Next point is cost effectiveness, very important point. Minimizing the overall cost of capital is a central goal. Since debt is cheaper due to tax benefits and lower investor expectations, it should be used to a reasonable extent. However, beyond a certain point, additional debt raises the firm's risk profile, increasing the cost of both debt and equity. Next point is leverage or trading on equity. This refers to the use of fixed cost funds, debt and preference capital to increase returns on equity. When the return now debt means you have issued debentures, you have to pay a fixed rate of interest. Preference share capital also you have to pay first dividend to them, then you can pay to equity shares. So this refers to the use of fixed cost funds, that is debt and preference capital, to increase the returns on equity. When the return on assets financed by debt exceeds the cost of debt, it enhances earnings per share. Earnings per share we write EPS. However, leverage also increases financial risk, and EBIT dash EPS analysis is used to evaluate the impact of leverage. A company with stable and high EBIT means earnings before tax, can benefit from greater leverage. For example, a firm with 80% debt showed higher earnings per share compared to an all equity firm, demonstrating the benefits of leverage if handled prudently. Next point is cost of capital. This involves choosing the mix of capital that results in the lowest overall cost of capital. Debt is generally cheaper than equity due to tax benefits, but over reliance on debt increases financial risk and could raise both debt and equity costs. Retained earnings are the cheapest equity source due to the absence of flotation costs and tax on reinvested income. An optimal capital structure achieves the best balance between cost and risk. Next is cash flow. The company's ability to generate sufficient cash flows is essential when deciding the level of fixed charge bearing instruments like debt and preference shares. Companies with strong and stable cash inflows can afford more debt. Conversely, unpredictable cash flows increase the risk of default and insolvency when fixed financial obligations are high. If the debentures are due, they have to be redeemed, then on that day company has to give the money to the debenture holders. Debentures should be redeemed on the date on which it is mentioned. Next point is control. A firm must weigh the impact of the financing decisions on ownership and manage control. Issuing new equity dilutes existing shareholders' ownership and voting rights, potentially effective control over company decisions. This is particularly sensitive in family owned or promoter controlled firms. Second is closely held private companies. Now next point is control. To retain control, such companies may prefer debt financing despite its fixed costs. Debt does not dilute ownership as lenders do not have voting rights. However, one must be cautious as excessive debt can lead to covenants, restrictions by lenders, or worse, loss of control during financial distress or bankruptcy. Thus, a trade-off exists between financial cost and control. Financial managers must assess whether maintaining control justifies the higher risk from debt usage. Next point is flexibility. A good capital structure should provide the firm with the flexibility to adapt to changing financial requirements. Flexibility means easily raising funds when needed, redeeming or restructuring securities without penalties, maintaining a buffer of borrowing capacity for emergencies or expansion. Now, next is flexibility. A rapid capital structure with high fixed obligations can restrict operational freedom. For instance, if all borrowing capacity is exhausted, the firm may be unable to fund a new project or survive an economic downturn. Firms in fast growing industries or those undergoing frequent changes in scale or strategy must emphasize flexibility while designing their capital structure. State of the company. The size of a company significantly affects its financing choices. Large firms have better access to capital markets and can obtain low cost funds through a variety of instruments. Smaller firms face higher interest rates and stricter loan terms. Loan terms are strict to them, restructuring their flexibility. As a result, they rely more on equity and retained earnings. Next point is marketability. Market conditions influence the limiting and nature of security issues. If investor sentiment favors debt, companies may opt for debentures. Otherwise, equity may be preferred. The state of the capital market plays a vital role in shaping capital structure choices. Next is floating cash. These are the costs involved in issuing new securities. Debt generally involves lower floating costs compared to equity. Retained earnings incur or flotation cost making them a preferable source. While this factor may be less significant for large firms, it plays a crucial role in capital structure decisions for smaller businesses. So, in this particular unit, now we see what we have studied. We have studied about capital structure. Capital structure is a vital aspect of financial planning as it directs influences the risk, return and cost of capital and overall value of the firm. If companies it comprises a mix of equity, preference shares, debt and retained earnings. An appropriate structure considers profitability, solvency, control, flexibility, market conditions and company specific factors. While they suggest an optimal mix to minimize cost and maximize market value, in practice decisions may rely heavily on human judgment and are influenced by company goals, industry characteristics, and external market dynamics. No universally correct formula exists, but a well judged balance ensures capital health and long term sustainability. Now we come on next unit, that is unit 11, leverage analysis, ratio analysis. Leverage analysis focuses on understanding how a firm's financial structure influences its profitability, risk profile, and overall performance. Leverage essentially refers to the use of fixed costs, both operational and financial, or to magnify returns. There are two primary types of leverage: operating leverage related to fixed operating costs like rent, salaries, etc., and financial leverage related to fixed financial costs like interest on debt. That is a financial leverage. Both types influences the firm's earnings in different ways. The main aim of this lecture is to explain the concepts, measures, and implications of leverage, especially financial leverage, that demonstrate how changes in leverage impact return on equity, earnings per share, and business risk. Now, financial leverage refers to the use of borrowed capital, debt, to finance the acquisition of assets. It arises due to fixed financial obligations such as interest on debt or dividends on preference shares. Though preference dividends are not tax deductible, the cost idea is that when a company uses debt and the return on the borrowed funds exceeds the cost of borrowing, it leads to a higher return on the equity, ROE. For instance, consider GTB Limited. It's a limited company who needs 80 lakh for a project. If it raises all through equity, the return on equity would be 24%. But if you raise it to 30 lakhs from equity and 50 lakhs from debt at 18% interest, the rate of interest becomes 46%. This rise in equity return due to the use of debt is called financial leverage. So what do we mean by financial leverage? Equity return due to the use of all debt, it is called financial leverage. It works because debt payments are fixed and are meeting interest obligations. The remaining profits accrue to shareholders, enhancing their returns. However, this leverage comes with risk. If earnings decline, interest still must be paid, increasing the risk of financial distress. Financial leverage can be quantified using ratios that compares debt to assets or equity. Debt to asset ratio, that is debt divided by total assets. Debt to equity ratio, that is debt divided by equity. let's say Bharat Engines Limited plans on investment of rupees 1 crore and is evaluating different levels of debt. The DA and DE ratios change depending on amount of debt used. For example, with rupees 80 lakh of debt, DA is equal to 80 by 100 is equal to 85%, and DE is equal to 80 divided by 20 is equal to 4 or 400%. These two ratios are mathematically related and can be converted into each other using formulas. Formulas are D oblique E is equal to D oblique A divided by 1 plus minus D oblique A. D oblique A is equal to D oblique E plus into bracket 1 plus D raised to power E. The analysis helps firms understand how much financial leverage they are using and evaluate it intensely. Note that DE ratio becomes infinite when all funds are raised via debt, that is 100%, while DA ratios caps of 100%. So we should not do like this. Financial leverage can marginally financial leverage can magnify profits as well as losses. It affects a company's return on equity and earnings per share. A firm earns a higher ROE and EPS when EBIT exceeds the interest cost on debt. But if EBIT is lower negative, financial leverage amplifies losses and reduces shareholder returns drastically. We all know EBIT is equal to earnings before interest and taxes. Effects of financial leverage. Let us examine Bharat Engine's performance under 4 different capital structures with increasing debt levels 0%, 20%, 50% and 80%. For each, the company experienced 3 economic scenarios: unfavorable, favorable, highly favorable. 25% EBIT unfavorable, 25% EBIT favorable, highly favorable, 50% EBIT. The findings are: at 10% debt, ROE ranges from minus 15 to 30%. At 80% debt, ROE ranges from 111% to 114%. Earnings per share swings from rupees 1.50 to rupees 11.40. Now, as debt increases, the sensitivity of ROE and EPS to changes in EBIT becomes sharper. This means higher volatility or risk in returns. Thus, financial leverage acts as a double-edged sword, enhancing profits while times are good and deepening losses in downturns. Now we come on operational leverage. Operational leverage arises from the presence of fixed operating costs in the business such as depreciation, salaries and rent. It relates to the firm's business risk or the uncertainty in predicting EBIT. Firms with higher fixed costs and low variable costs have higher operating leverages. This causes profit to be more sensitive to changes in sales value, volume. Now next is operating leverage. Now let's compare 3 firms ABC, each selling rupees 10 per unit but with different cost structure. Firm A lowest fixed cost rupees 1.5 lakh, highest variable cost rupees 7 per unit. Firm B moderate fixed and variable costs. Firm C higher fixed cost rupees 4.5 lakh, lowest variable cost rupees 4 per unit. Use the degree of operating leverage DOL. Formula is DOL is equal to percentage change in EBIT, percentage change in sales. If firm C increases sales from 80,000 to 90,000 units, profit raises by 160%, showing very high operating leverage. On the other hand, if firm A's profit rise only by 26.7% for the same sales increase. Next is operating leverage implication. High operating leverage magnifies profit changes. Firms with high DOL must achieve high sales volume to remain profitable. Such firms may opt for aggressive pricing strategies to boost volume. Next is combined leverage. Combined leverage is the total effect of both operating and financial leverage. It shows how a change in sales affects the income or earnings per share. It is calculated as DCL is equal to DOL multiplied by DFL, where DOL is degree of operating leverage and DFL is degree of financial leverage. Next is combined leverage. For example, Bharat Engines with 80% debt experiences a DFL of 1.92, that is a 10% rise in EBIT leads to a 19.2% rise in net income. It controls with only 20% debt. DFL is 1.14. A higher DCL means higher risk and return potential. Hence, firms with high operating leverage should be ideally maintain low financial leverage and vice versa to keep overall risk manageable. Now, financial leverage and risk. A leverage increases, businesses also rises risk. Here is the possibility of variability in return due to changes in economic conditions, sales or cost. Risk can statistically measured using the coefficient of variation CV. It is equal to standard deviation divided by mean return, return on equity. Now, as debt rises, CV rises significantly, showing greater volatility in returns. Hence, leverage must be used strategically, balancing return maximization with risk management. Now, based on Bharat Engines performance under 4 different capital structure, we find when debt is 0%, ROE is 135%, standard deviation is 0.157, then CV risk level is 1163. Then next is when debt is 20%, ROE is 14.6%, standard deviation is 0.196 and CV is 2228. Next is 80%. If suppose debt is 80%, ROE is 16.5%, standard deviation 0.647 and CV is 3919. Now we come on the summary. Financial leverage. Use of debt to enhance returns on equity effective only if return on assets exceeds the cost of debt. Operating leverage. Use of fixed costs in operations with high DOL means higher business risk and sensitive to sales changes. Combined leverage multiplies the impact of sales fluctuations on earnings per share or net income. High combined leverage implies high risk. Leverage amplifies both profits and losses, increasing returns potential and financial vulnerability. Proper leverage planning depends on the company's industry, sales, stability, cost structure and risk profile. Coefficient of variation is used to assess average related, risk quantitatively. The important ratio is debt equity ratio, debt divided by equity. DA ratio is debt divided by debt plus equity. DOL is equal to percentage changes in EBIT divided by percentage changes in sales. DFL, percentage change in net income divided by percentage change in, EBIT. Next is DCL, is equal to DOL multiplied by DFL. Then CV, cost standard, deviation divided by mean. Our CV is equal to standard deviation divided by, mean. So, in this particular chapter, we have studied, leverage analysis. Leverage analysis focuses on understanding how a firm's financial structure influences its profitability. Now, there are two primary types of, leverage: operating leverage and financial leverage. Both types influence the firm's earnings in different ways. The main aim of this unit is to explain the concept, measures and implications of leverage, especially financial leverage, and demonstrate new changes in leverage impact, return on equity, earnings per share and overall business risk. Then financial leverage refers to the use of borrowed, capital fund to finance the acquisition of assets. GTB Limited, which needs rupees 80 lakh for a project, if it raises all through equity shares, the return on equity would be 24%, but if it raises 30 lakh from equity and 50 lakh from debt at 18% interest, the ROE becomes 45%. This rise in equity return due to the use of debt is called, financial leverage. Now, financial leverage, if it works because debt payment are fixed and after meeting interest obligations, the remaining profits accrue to shareholders, enhancing their returns. Then measures of financial leverage, debt to asset ratio. Next is debt to equity ratio. Then financial leverage, the DA and DE ratios change depending on the amount of debt used. For example, rupees 18 lakh of debt, DA is equal to 80 divided by 100 is equal to 80%, DE is equal to 80 divided by 40 divided by 20 is equal to 4%. These two ratios are mathematically related and can be converted into each other using formula DE is equal to DA divided by 1 minus D oblique A. DA is equal to D plus 1 plus D oblique E. Then we studied measures of financial leverage. This analysis helps firms understand how much financial leverage they are using and evaluate its intensity. Now, effects of financial leverage can marginally profits as well as losses. If it affects a company's, So financial leverage can, you see, magnify profits as well as losses. It affects a company's return on equity and earnings per share. A firm earns a higher rate of interest and earnings per share when EBIT, you see, exceeds the interest cost on debt. But if EBIT is low or negative, financial leverage amplifies, you see, losses and reduces, you see, shareholders' returns drastically. Their dividend is reduced. EBIT is, you see, earnings before interest and, you see, taxes. Now Bharat Engine's performance under 4 different capital structures with increasing debt levels at 0%, 20%, 50% and 80%. For each company experiences 3 economic scenarios: unfavorable 25%, favorable 25%, then highly favorable, you see, 50%. Now effects of financial leverage at 0% debt, ROE ranges from, you see, 15% to 30%. At 80% debt, ROE ranges from 111 to 114%. EPS swings from, you see, 1.50 to 11 point, you see, 40. At debt percent we left out, rate of interest, you see, ranges from 15% to 30%. As debt increases, the sensitivity of ROE and EPS to changes in EBIT becomes, you see, sharper. This means higher volatility or risk in returns. Thus financial leverage acts as a double-edged, you see, sword, enhancing profits when times are good and deepening losses in, you see, downturns. Operating leverage, you see, arises from the presence of fixed operating costs in the business. Then combined leverage is the total effect of both operating and financial leverage. It shows how a change in sales affect net income or earnings per share. Then financial leverage and risk. As leverage increases, business risk also rises. Risk here is the possibility of, you see, variability in returns due to changes in economic conditions, sales or costs. Then coefficient of variation CV, statistics, coefficient of variation CV is equal to standard deviation divided by mean, you see, return. Financial leverage and risk. As debt rises, CV rises significantly, showing, you see, greater volatility in returns. Hence leverage must be used strategically, balancing return maximization with risk, you see, management. Now we have studied financial leverage, operating, you see, leverage, combined leverage. Then leverage amplifies both profits and losses, increasing returns potential and financial vulnerability. Proper leverage planning depends on the company's industry, sales, stability, cost structure and risk profile. Coefficient of variation CV is used, you see, it is from statistics, used to assess, you see, leverage related risk quantitatively. Now we studied the important formulas: D ratio, DA ratio, DOL, you see, DFL, DCL, CV. So our formulas are D, debt equity ratio, DA, debt divided by debt plus equity. DOL is equal to percentage change in earnings before income and tax divided by percentage change in sales. DFL is equal to percentage change in net income divided by percentage change in earnings before interest and tax. Then DCL is equal to DOL multiplied by DFL. Then CV is equal to, you see, standard deviation divided by mean, you see, expected return. So in this particular unit we studied the ratios also. Ratios are, we studied D ratio, DA ratio, DOL, DFL, DCL, CV. So leverage amplifies both profits and losses, increasing return potential and financial vulnerability. Proper leverage planning depends on the company's industry, sales stability, cost structure and risk, you see, appetite. Coefficient of variation CV is used to assess leverage related, you see, risk quantitatively. Then we saw the formulas D ratio, DA ratio, DOL, DFL, DCL, CV. So students, we are closing this class. Thank you very much, students. Thank you very much.